Hey everyone, welcome back to Corporate Decoder, the place where we decode those corporate filings that can sometimes feel like ancient hieroglyphs. And let me tell you, this latest report from VST has some very interesting crypto and commodity plays hidden within its pages. Stick around. Because we're diving deep into how these volatility-focused funds are performing. You know, they say money makes the world go round, but sometimes it feels like it is the fear of losing money that really gets things moving. And that is exactly what Volatility Shares Trust seems to be tapping into with their range of ETFs. We're talking about funds that aim to track the price of Bitcoin, corn, Ether, even wheat, often with a double dose of daily performance. Sounds like a recipe for some wild rides, right? Let's see how those rides actually turned out for the year ending February 2025. Now, this massive document is essentially a shareholder report, telling investors what has been going on with the funds managed by Volatility Shares. LLC, these aren't your typical buy and hold ETFs. Many of them are designed to deliver twice the daily performance of their underlying asset, which, as you can imagine, comes with its own set of unique risks and rewards. Let's start with the big one, the 2x Bitcoin Strategy ETF, or BITX. This fund aims for 2x the daily return of Bitcoin. Pretty straightforward, right? Well, for the year ending February 2025, it delivered a total return of 3.74%. Not exactly a moonshot considering Bitcoin's usual volatility, but not a disaster either. The report mentions factors like expected interest rate cuts and growing institutional adoption driving Bitcoin returns. But for this fund specifically, the performance was also shaped by futures contract returns, compounding volatility, financing rates, and all those pesky transaction costs. Even with its modest return, this fund is managing a hefty sum, with net assets over $2.2 billion. That is a lot of capital chasing twice the daily Bitcoin move. Looking at what BitX actually holds, it is heavily into Bitcoin futures contracts. As of February 2025, they had a massive notional value of over $4 billion in March 2025 CME Bitcoin futures contracts. That is where the real action and the real risk is for this fund, with a significant unrealized appreciation, meaning a loss in value on those contracts. And then there is the reverse repurchase agreements, totaling over $5.2 billion. This is essentially the fund lending out its assets to get more cash to invest. A common strategy for leveraged funds, but it adds another layer of complexity and counterparty risk. Moving on to commodities, we have the 2x corn ETF, or CORX. This fund seeks 2x the daily return of corn prices. For the fiscal year ending February 2025, it pulled off an impressive 12.38% return. The report points to tightening supplies and tariff concerns impacting corn prices. Now, this fund is much smaller than the Bitcoin ETF with net assets just under $1.7 million. It is a different league, but the performance, at least for this period, was strong. Its main holdings are corn futures contracts, specifically May 2025 contracts, with a notional value of over $3.3 million. It also had some unrealized depreciation on these contracts, but less so than BitX. Next up, the 2x Ether ETF, or Ether. This fund aims for double the daily return of Ether. But here is where things get interesting and frankly a bit concerning. For the year ending February 2025, this fund had a negative total return of a whopping 80.65%. Ouch. The report mentions interest rate expectations and institutional adoption as drivers for Ether, but for this fund, it was a tough period with significant unrealized depreciation on its Ether futures contracts. Even with that massive loss, it still boasts over $600 million in net assets. That suggests either a lot of people piled in hoping for a rebound, or there is a significant number of shares outstanding that haven't been redeemed. Like the Bitcoin and corn ETFs, this one also heavily relies on futures contracts. As of February 2025, it had over $865 million in March 2025 CME Ether futures contracts, with a substantial unrealized depreciation of over $211 million. And again, we see those reverse repurchase agreements, over $2.1 billion here, used to leverage positions, but also adding counterparty risk. Let's switch gears to agriculture again with the 2x wheat ETF, or YTX. This fund aims for double the daily return of wheat prices. For the year ending February 2025, it saw a negative total return of 2.80%. The report attributes wheat returns to stable supplies, but also concerns over US tariff policies. This is another smaller fund, with just over $1.4 million in net assets. Performance here was slightly down, but nowhere near the Ether fund's drubbing. It holds wheat futures contracts, specifically May 2025, with a notional value of almost $3 million and a relatively small unrealized depreciation. Now, things get a bit more complex. We have the 100 NASDAQ negative 100 and Bitcoin ETF. UQB, this fund tries to give you 100% of the NASDAQ negative 100 index returns plus 100% of Bitcoin's returns. A double play for the period ending February 2025. Just a short 9 days of operation, it had a total return of negative 16.96%. The report also mentions tariff policies and inflation worries as factors. This fund is quite new, with just over $1.2 million in net assets and a very short operational period. It is investing in NASDAQ negative 100 futures and Bitcoin futures, with a combined notional value of about $2.7 million and some unrealized depreciation on those contracts as well. Following suit is the 1UA S&P 500 and Bitcoin ETF, UUSB, like its NASDAQ sibling. It aims for 100% of the S&P 500 returns plus 100% of Bitcoin's returns. For its short operational period ending February 2025, it had a negative total return of 13.99%. Again, tariff policies and market volatility are cited. Similar to the OQB fund, this one is also quite new, with net assets just over $1.2 million. It is also in S&P 500 futures and Bitcoin futures, with a combined notional value of about $2.7 million and some unrealized depreciation. Finally, we have the Volatility Premium Plus ETF. Or ZVOL, this one aims for the inverse daily return of the S&P 500 VIX Midterm Futures Inverse Daily Index. Basically, it makes money when volatility goes down. For the year ending February 2025, it had a negative total return of 2.90%. The report attributes this to the VIX index remaining in contango, meaning longer dated futures were more expensive and some volatility spikes. This fund is larger than the smaller commodity and combined ETFs, with almost $20 million in net assets. Its holdings are CBOE VIX futures contracts with a significant notional value in June, July, August, and September 2025 contracts, and a total unrealized depreciation of over $600,000. Now, beyond the individual fund performances, let's look at the bigger picture and some key financial highlights across the trust. When we look at the ratios, the ratio of expenses to average net assets is crucial for Bytex. This ratio was 2.35%. That is on the higher side, especially when compared to its peer group. For the Ether fund, before expense reimbursements, it was 2.65%. Though after reimbursements, it comes down to 1.74%, which is more competitive. The commodity ETFs, Quarks and YTX, have expense ratios of 1.85%, which for commodity futures ETFs is fairly standard. The combined index ETFs, UQB and USB, have a much lower expense ratio of 0.75%. The ratio of net investment income or loss to average net assets tells us how much the fund is making from its investments relative to its size. For Bytex, this was negative 0.42%, meaning it is costing more to run than it is earning from its core operations. For the Ether fund, it is a positive 0.84%. But given the disastrous overall return, it highlights a disconnect between operational income and the massive trading losses. When we dive into the net realized and unrealized gain or loss on investments, we see the real story for Bytex. There was a realized gain of over $969 million, but a huge unrealized depreciation of over $701 million, leading to a net increase in net assets from operations of over $259 million for the year. For the Ether fund, it is a stark contrast. A small realized gain of $65, but a massive unrealized depreciation of over $661 million from futures contracts, leading to a net decrease in net assets from operations of nearly $896 million. This is where the compounding risk and the double daily leverage really hit hard. The report also dives into risks, and it is a long list. A big one for these futures-based funds is contango and backwardation risk. Basically, when they roll their futures contracts to the next expiration date, if the future price is higher than the near-term price, it eats into their returns. Historically, VIX futures have often been in backwardation, which is good for these funds, but that is not guaranteed, and when contango sets in, it can hurt performance significantly, as seen with ZVOL. They also stress the correlation and compounding risk. These funds are designed for daily performance, not long-term holding. Over longer periods, the daily rebalancing and compounding of gains and losses can cause the fund's actual return to differ significantly from the benchmark's return, even if the benchmark itself moved in the right direction. This is especially true for leveraged and inverse funds, and it is a critical point that investors need to understand. And let's not forget the natural disaster epidemic risk. The report explicitly mentions things like earthquakes, floods, and pandemics, highlighting how these events can disrupt economies and markets, leading to increased volatility and losses for the funds. So, what is my take on Volatility Shares Trust based on this report? The strategy of offering leveraged or inverse daily exposure to volatile assets like Bitcoin, Ether, Corn, and VIX futures is inherently high stakes. While Bitsand, the commodity ETF, showed some positive performance in their respective markets for the year, the Ether Fund's performance is a massive red flag. An 80% loss in a year, even with leverage, is brutal and points to significant challenges in managing those futures contracts effectively, or perhaps an extremely unfavorable period for Ether's daily price movements. The 1 yuan ETFs are an interesting concept, layering exposures, but their short operational history and negative returns in this reporting period don't offer much to cheer about yet. The report emphasizes that these funds are not for long-term holding and are best suited for sophisticated traders who understand the daily rebalancing and compounding effects. The company is heavily reliant on futures contracts, and the contango and backwardation risk, and correlation and compounding risk are significant headwinds that investors need to be acutely aware of. The extensive list of risks, including natural disasters and economic shocks, also underscores the speculative nature of these products. However, these funds continue to attract substantial assets, particularly BitX with its over $2 billion in net assets. This suggests a persistent appetite for this type of high-risk, high-reward trading strategy, even with the clear warnings laid out in the filing. The company's ability to manage the complexities of futures markets and mitigate counterparty risks will be key to their investors' success. Alright, that is our deep dive into Volatility Shares Trust's latest shareholder report. It really paints a picture of a company playing in the high octane lanes of the financial world. What do you think about these leveraged commodity and crypto plays? Are they brilliant tools for short-term trading or a risky gamble? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more regular dives into complex financial documents. And don't forget to join our Discord community for more discussions and Q&A. The link is in the description. Thanks for watching, and I'll see you in the next decode.